All right, thank you so much. Good morning, good afternoon, and good morning, good afternoon, and good evening, wherever you are in the world. My name is Stephen Place. I'm the founder and head trader at Investing with Options. And before we get started, one quick audio video check for me. If you can hear me and see my screen, let me know in the chat. Also, let me know where you're coming in from, city, state, country. I've seen Dave B coming in from Iowa. Tom Z, Lake in Michigan. Apparently there's a meteor shower coming through, so that's exciting. I'm going to make all of you up basically north of the Mason-Dixon really jealous right now because tomorrow it's going to be a sunny 73 degrees in the Panhandle, Florida. I am going to go to the beach for lunch, and I'm going to trade from there. Should be a lot of fun. JJ from New Jersey, Ronnie from TX, Texas, Larry, Indiana, Raymond Hauser from D, Dallas. Over in New Jersey, Ed from Connecticut, Roy coming in from Tennessee, Houston, Santa Rosa, California. Thank you all so much for coming and spending some time with me on how to better yourself and how to better your trading. We're going to look at these slides and we're going to hop back and forth a little bit between the slides and live prices as well. This is not an evergreen kind of thing that we're talking about. This is very relevant to what the market is showing us right now. So we can take a look, for example, if I drag over the S&P, the market broke above 3020 and we have not seen a pullback in over a month. One streak that I've been following is the consecutive days without touching the 10-day moving average, and it's been a very, very long time. It's statistically significant. We haven't seen that happen in a very long time. So what we want to do here, we don't have to be bearish on the market. We just want to be prepared for if and when the pullback comes. What strategies can we employ? What kind of planning can we put in place so that when it does come, we are prepared for profits? Everyone has seen this slide. This is the disclaimer. Options trading can change your life. Whether it changes it for the better or for the worse is completely up to you and how you manage your risk, what kinds of trades you take, what kind of position size you put on will let you know if you're going to be successful throughout your trading career or if you're going to blow out your account. Options trading, just like leveraged stocks, futures, Forex, tulip bulbs, Bitcoin, all of these things have the potential to run to zero. So you do have to keep that in mind when you are playing with options. You are dealing with leverage. And leverage, when managed properly, man, it's a beautiful thing. And it can lead to wealth and compounding that can drastically improve your life. For those of you that don't know me, my name is Stephen Place. I'm the head trader at Investing with Options. And I help folks just like you realize their financial dreams through options trading. There's a lot more I could talk about myself and what I do and the systems I employ, but let's just go ahead and get into it. When we think about buying the dip, there are lots of, it's a loaded phrase, right? When you say, oh, I can't wait to buy on the dip, the immediate reaction that most people have is, okay, as soon as you do that, the market's going to fall out of bed. Right, and that's not what I want to have happen. That's not what I want for you. But it can be incredibly painful, not just from costly losses from being entirely too early, but also from missing out as a market or a stock continues to grind and grind and grind without any pullback. So we're going to talk about some indicators. We're going to talk about the things that I look for when anticipating a move back to the mean, some reversion where I can take advantage of. We're going to talk about some option strategies, and we're going to talk about some psychology as well. Okay? So here's how dip buying looks like on paper. So this is a chart of Lululemon. Lulu, L-U-L-U, is one of my favorite trading instruments. It's one of my favorites, absolutely. But here's an example. It has a gap higher on earnings, continues to drift lower, tags the 50-day moving average, puts in a hammer candlestick. Everyone knows what a hammer candlestick is, right, since we're in candlestick form. And then it breaks out. So if you buy that dip, easy peasy, lemon squeezy, you just take the profits and then you move on. And sometimes that's how it works. Sometimes it is just that simple. And as long as you're prepared for that price level to get filled, then you can make some really good money. Other times, this is what it looks like, where you say, okay, I'm going to buy the dip, let's just say right here, and then the stock completely falls out of bed. Right? What are the things that we need to do? What kind of stock selection can we use to help avoid this kind of costly loss? Right? But that's normally what people perceive in terms of what's painful for you, what hurts when you buy the dip. But from my experience, yes, those kinds of things are not good, but it's also something like this, where if you look for a dip and you say, okay, the dip is going to come, and once it gets there, sure, you know that level could be a potential level of support, but you don't have the psychological fortitude to load up, and then you just get a one-day pullback, and that's it. And then the stock is just going off without you. There is not just costs in terms of trading losses. There are costs in terms of opportunity cost and missing out on good moves. So those are the kinds of problems we face when we buy the dip. I'm assuming that all of you in here have had experience with this in one form or another. So we know the problems now. We know that buying on the dip is a very good solution to, it's a very profitable trading system to have. But oftentimes we get smoked by picking on the wrong stocks, or we lose out in terms of opportunity because we were not prepared to say, okay, here's when price comes back into play. Okay. We're going to talk about systems and option strategies in just a second. But you have to understand that often dip buying is a psychological problem. That it's not necessarily your trading system or the kinds of options you're choosing or the kinds of stocks you're trading. Often it's what's going on between your ears, because we primates have not completely evolved to disassociate between the risks of a saber-toothed tiger that's about to attack you and financial losses where a stock drops $1. Your brain can't distinguish between the two. It's your lizard brain. It's called the amygdala, right? And it's annoying, and we just have to identify it and find a way to resolve it. So the first thing I would like to tell you is that you must pivot away from a scarcity mindset. There's always this fear that if you don't get in on the next trade, that's going to be the only trade you will be able to take ever again. Right? We need to pivot away from scarcity mindset and into abundance mindset, and understand that the amount of money available every single day in the financial markets is awe-inspiring. It's trillions of dollars at play every single day. Forex, bonds, stocks, right? All of those things come together, and there are opportunities that are always going to be there. Think about this. What if you just took a 2-week break from trading? Do you think there's never going to be an opportunity again? Right? So what that means is, let's just say you didn't get the dip and you didn't manage to buy a stock at 60 and now it's trading at $100. Does that mean there's never going to be an opportunity in that stock again? No, of course not. Right? I don't care if Apple is trading at $100 or $500. I don't care if Amazon's trading at $1,000 or $2,000, because the natural volatility of those stocks allows you to profit. Profit is profit. It doesn't matter where it came from. Okay? So here's 2 scenarios. Let's take trade number 1. You buy the stock at $20, you sell the stock at $30. You have trade number 2. You buy the stock at $50, you sell the stock at $60. All right, which one's the better trade? Let me know in the chat really quick. Which one do you think is the better trade here? As I take a sip from my drink. Right. Jay's got it nailed. Everyone's saying 1, right? Because you say, okay, if I buy 20, sell at 30, that's a $10 gain, that's 50% return. Right? Instead, if you buy at 50, you sell at 60, that's a $10 on a $50 stock, it's 25% return. I'll tell you what, I don't pay my rent in percentage points. right? We are traders. We are financial speculators. We're not investment managers. There is a completely different game played when we talk about asset allocation and alpha and beta, and they always look percentage points. The $10 move is a $10 move, right? Assuming position sizing is equal and everything like that, it doesn't matter where the stock is trading, which means if you miss out on a stock that has run from, $60 to $80 and then you see a pullback, don't allow your lizard brain to anchor onto the previous pullback levels, because there's still going to be opportunities here. Okay? What I call this at least, is being price agnostic. We care about the profits that we pull in, and that's it, right? It's one of the funny things that I like to hear when people talk about the markets. They say, oh, it's a low volume rally, right? Well, if you bought the market and then you sell it later, it doesn't matter what volume it has. There's no bank statement where you take profits out of your account and use it to buy a car. The auto dealership is not going to ask if the market was in low volume. They're not going to ask, well, did you pull 8% or did you pull 12%? Right? Profits are profits. Okay. Now, Rama in the chat is saying risk factor is also needed. So one is a better trader. We're keeping this simple. What I do is I think in terms of R and R multiples and things like that. But again, what I'm trying to do here is condition you into saying, hey, you know what? Maybe I missed this most recent move in Apple. But that's okay, because if it does pull back, I'm going to look for some opportunities there. Now, I'll go ahead and put another caveat here. My focus is on very liquid option markets. And very liquid option markets tend to be stocks and companies that are institutionally held and observed. So we're not talking about penny stocks. We're not talking about biotech stocks or things like that. There is a little bit of a different game there. What was the stock recently? I think it was KRTX, right? Where you have this kind of move where KRTX has phase 2 data come out, and it runs from $30 all the way up to $120. Okay, so we're not talking about that case. All right, so I'm talking about larger capitalization companies with very large floats that are institutionally held. All right, so we can take a look instead at something like Apple, where I don't care if Apple's trading at 260, I don't care if it's trading at 200, I just care about the profits. As long as the setup is there, I'm fine with trading it. Okay? So we're going to take a look at 3 separate setups. All right, and this is in Lulu. This is in Lululemon. 3 separate setups on the stock over the past few years. And what I want to show you is that I don't care if Lulu's trading at $80 or $100 or $120. I just care about profits. So this is an example. This is from a couple years ago when Lulu was trading at $80 a share, and it had this move right here, and then it pulled back into its 50-day moving average. So we'll get to the option strategy here in a little bit, but this is one trade that I really liked, where selling the April 70-65 full put spread, where you sell the 70 put, you buy the 65 put, and as long as the underlying stock stays above $70 going into expiration, it's a good trade, and that trade makes money. All right, and that was on March of 2018. Now fast forward here, and we already looked at this setup a little bit, where Lulu is not trading at $80, it's trading at $190. But the setup there, it's still there, right? You get a breakout on earnings, pulls back to the 50-day moving average, puts in a hammer candlestick, right? Breaks out above all its major moving averages. It's above the T-line. The T-line is not shown, but you all know where the T-line is. It's right about here. We see a strong move. So, same kind of trade. Sell to open the NOV, 180, 175 will put spread at 90 cents. Right? And that's almost a year and a half later. And the stock is $100 higher. If I was trying to invest in the stock as an institution then we would care a lot more about price. But because we are traders, we are in the moving inventory business. We're not in the ownership of the company. We are trading the volatility of the stock. Okay? Here's the next one. And this one was just a month or two later. Right, so here's the first setup. Then it sees another breakout, pulls back to the 50-day moving average again. So what do? Sell to open, the D's, 170, 165 bull put spread at 74 cents. And this was just 1 month later. As long as the pullbacks are coming, that's fine. Now this one, in this particular case, the original entry for the second trade was 195, and we managed to get it again at 195.5. All right, so you can go back to the same stocks over and over again, just trading the natural volatility of these stocks. So what are some things that we can do to really get our edge? Because we know a lot of it is going to be psychological in nature. We know a lot of it is going to be the lizard brain saying, you know, you're waiting for that pullback, and once the pullback comes, you get scared because you don't want to buy there. You don't want to buy that dip because all of a sudden it seems too scary, and by the time everyone realizes it's not scary, the stock has already moved. All right, so there's a couple different things that I like to do to find these setups. Okay. Step one, find stocks to buy a pullback in. I have an options trading watch list that has pretty much stayed the same over the past few years. Every once in a while I'll add some stocks in when they start to catch some interest. But I have a list of about 75 stocks that I just look at over and over again. Okay, these tend to be the most liquid stocks that have the most liquid options markets that tend to have high volatility on an absolute basis. So ideally, I want stocks that are moving $1 a day. With the introduction of $0 commissions, that matters a lot less, but it's still something that I look at. I would rather trade something like an Apple or an Amazon than a General Electric or a Ford. Just on an absolute dollar basis, I want that kind of movement. Now, what I do here is I have something that I call the upside down method, because what tends to happen is that traders will wait for stocks to get deeply, deeply oversold. And I don't want that. What I've found is that when stocks are overbought, that tends to be the best opportunity for us. Okay, stocks that have been the strongest over the past few weeks, that first pullback tends to be a very good buying opportunity. So what I do is I have an upside down list. I'm not looking for the worst stocks, the most oversold stocks. I'm looking for the best stocks. And then once I find those best stocks, I want to start planning my entries based off of previous price levels and indicators that I watch. So this is the same list, and this is what it was sorted to today. So right now, for example, Target is running hot on earnings. Amgen and IBB. IBB is the biotech ETF, right? So biotech's been running hot. Tesla had that really good earnings where they had free cash flow positive for the first time in a while. QRVO is a chip company. General Electric was running hot. Zendesk is coming off the lows. Lululemon's still in there. It's got earnings coming up. Big cap financials, Intel, Microsoft, Disney, Netflix, some of the usual suspects. So those are sort of the strongest stocks that I'm watching in my watch list. And then what I do is I just go through all of those and I say, hey, you know what? I don't necessarily want to be bullish on the stock right now, but where can I find a price level where the risk reward is really in my favor? Okay. So what we want to do is we want to plan our entries before your best prices hit. And this helps to eliminate the lizard brain fear involved. Because what I like to do is I will say, okay, if this price level is hit, what kind of option pricing will be available? And then I'll just automate my option trading so I don't have to think about it anymore. So let's talk a little bit about how to identify some of these dip buy support levels. I am a huge fan of what's known as auction market theory. All right, so this is a level 2 chart, and this has the bid on the left side, and then the bid size, and then the ask on the right side, and then the ask size. So this is a stock that's trading with a bid of 199.17 and an ask of 199.18. There are willing buyers at 199.17. There are willing sellers at 199.18. The only way for price to move up is if you start to find buyers that take out the ask. The only way for price to move down is if sellers start to take out the bid, okay? Or if the ask rises and the bid drops respectively, okay? That look at what's known as market microstructure helps to figure out what we want to do. So you have on the left where the overall demand is, and on the right you have supply. If supply is greater than demand, price goes down. If demand is greater than supply, price goes up. Okay? We want to keep it really simple at first. When we look at price support, all we are looking to do is identify levels in which we expect demand to exceed supply, in which we expect the inventory of stock to be low enough that prices have to rise higher. So here's an example. This is in MasterCard. And MasterCard, it's not been the strongest stock in this market, but anytime it pulls into the 260s, that has tended to be a level in which buyers have shown up aggressively. And price tends to have a memory. If there was a willing buyer at 260, odds are there are going to be willing buyers at least one more time. The more times the price level is tested, the higher odds of breakdown, so there's always that risk. But as you can tell, you had right here a gap down on earnings that was bid up aggressively. All right, anytime you see a gap down on earnings that fails to see follow through to the downside, that tends to be a low in the stock. Okay, so we see that price rejection from those levels, which indicates there are responsive buyers. So anytime we come back and we test this level right here, that's going to be a good opportunity. When you have very, very strong stocks, they will rarely test previous price supports the first time around because they're just so stinking strong, right? So this is the first kind to watch. And then the second kind that I really like is prior price resistance. So this is a chart of Nike. And Nike got hit on news that their CEO was leaving or something like that. It pulled into $90 a share, okay, which just so happens to be the top end of the range that Nike had been trading in. There was also an earnings gap fill that was attempted. But just observe price right here. As soon as it pulled in, any attempt to find follow-through to the downside was faded. Right? You had that first test of the rising 50-day moving average, and any attempt to find follow-through to the downside was met with buyers. That tells us that odds are demand is going to exceed supply and price has to go up. I also look at major moving averages. So I know Steve looks at the T-line, and that is a very useful indicator. I like to look at longer-term moving averages. The main ones that I focus on are the 20 and the 50. So you can't see the 20-day moving average on this chart because it's dark blue, but it looks something like this. Okay. Here's the first test of the 20-day moving average after a strong move. You can see how it was just filled on the dot. So I'm looking at the next test at 260, and then maybe we see a push to the 50-day moving average right here. Okay, but that is going to be, you know, what we also want to look for is something called confluence, where if we can align multiple levels on top of one another, then they tend to reinforce each other. So for example, you had this push right here, and you also have the 50-day moving average. Any kind of strong sell-off into the 250s down to the 240s is going to be a good risk reward, at least on the first test. Okay, because this comes down to the idea that stocks don't go up and down. They go up, sideways, down, and then down, sideways, up. So let's just say the stock pulls back and then maybe it pulls back just a little bit more, odds are we're going to see a bounce. Do you want to buy that second bounce? No, probably not. Maybe you get away with it. But if it sees a third test of that level, odds are the supply of owners of the stock will go away, and then price will auction down. Okay? Everything I do is within the context of thinking in terms of what are the motivations of buyers or sellers and what prices will motivate them to do something. Okay? Support level number 4. This one's a little judo. So we look at the RSI. RSI stands for Relative Strength Index. And buying a stock when it's deeply oversold on the RSI is not necessarily the best strategy. So if you don't know, here's a chart of the RSI right here. And it's an oscillator, and it basically shows you how many days did we see a rally, how many days did we see a sell-off, what was the strength of the rallies, what was the strength of the sell-offs, right? You would think that, and it has levels where you have 70 and you have 30 down here. You can also look at 80-20 if you want. But the idea that it's a good risk reward to look for stocks that are deeply oversold in the RSI indicator is not a good idea, because oversold stocks like that tend to get more oversold. And the converse is true. Overbought stocks tend to get more overbought. So if you do want to look for a pullback in using this indicator, you don't want to look for an oversold reading. You want to look for the RSI to come back into the 50 and 60 range. And that will tend to be a good spot in which you will see a dip buy opportunity. So if we look at AMD back in June, right here, the stock got overbought, right? Did it go all the way down to oversold? No. It came back into the 50-60 level, tested that rising 50-day moving average, and it held. And that's a good dip buy opportunity. One other level, and this is of my own doing. Just give me 1 second as I take a drink. All right. This is called the turning point indicator, and this is my own creation. And what this does is it gives me a good idea of how early I am in a stock. Right? So this shows us the rate of change over a certain time period. And I could go on and on and on about this, right? But the basic idea is saying, okay, over a 10-day window, how far does a stock normally sell off? So for this example, AMD over a 10-day period, maybe that's not 10-day, maybe that's 25-day, it sells off 10%. So you can say, okay, if the stock sells off about 8 or 10%, probably a little bit less than that, you can start identifying levels of support from there. So for example, the stock recently peaked around something like $40. So you take 10% off 40, that's 36, right? That's right here. That was also the range right before the stock started to rip higher last week. That also is coincident with this range right here. And I don't have them drawn, but I'm pretty sure there's like a 20-day moving average that comes down. So if you see AMD coming to 36, you want to start identifying if that's a good support level. Now, once you figure out those levels, what you can do is you can start waiting for confirmation. You can start looking at candlesticks. You can look for hammer candlesticks. You can look for bullish engulfing patterns. You can look for piercing patterns. You can look for abandoned babies to the downside or gaps down that have failed to see follow through to the downside. If you really want to go deeper, then you go into level 2 charts, right, and you start watching the bid and the ask, and you're saying, okay, the bid keeps dropping to, let's just say, 35.98, and it's getting hit really hard with all of these sells, but it's failing to see any follow through to the downside because there is a stubborn and persistent bid at 35.98. It's sopping up all of those sell orders and all those stop losses. That indicates to you that there's a willing buyer that will continue to stick around there. And that gives you really great entries. Okay, so using all of these support areas and looking for confluence, and then zooming into shorter term charts and shorter time frames, and if you really want to get into the witchcraft, you start looking at level 2 charts to say, okay, are we really seeing this on the market microstructure? Then you have the setup for really great dip buy opportunities. CE is asking what level 2 charts are. So this is an example of a level 2. This isn't a full level 2. You can also call it depth of market, but basically what we're looking for is what's the size on the bid, what's the size on the ask, and then what you can do is you can read the tape and you can look at filled orders. And you could say, let's just say, for example, this stock sold off from 205 to 199.17 right here, just as an example. And what you're seeing on the tape is you're seeing a bunch of sell orders hit 199.17, but the bid size doesn't change. That indicates what's known as an iceberg order that's used by institutions to hide their size. And if you see an iceberg order that's continuing to prop up a stock, that indicates institutional support at that level. All right, that's some serious advanced witchcraft. I'm trying to keep it a little bit simpler tonight, a little bit lighter tonight, but that's the kind of thing you can start to look for if you want to be super aggressive with your entries. Now, if you don't want to do that, I also have the solution for you. So what you can also do is you can stack the odds in your favor with options. So my firm is investing with options, so we are looking for ways to put our capital into options to get the best kind of risk and return. We touched on it briefly when we looked at Lululemon, looking at ways to enter into the same stock over and over again, regardless of what price we have. When we talk about dip buy setups, the simplest way to trade is what's known as a bull put spread. Now, you've probably heard about these. A lot of people trade them. A lot of people lose money with them because they're bad at it. And so what I want to show you is that there's a difference between a trade idea and the execution of the idea. And you can really get an edge by changing the executions of your idea. Okay? So where we stand right now, we've talked about psychology. We've talked about some of these indicators. And you've probably heard about a moving average, right? But we're going to start to get in a little bit more advanced. We're about to jump off the deep end. So Dave's asking, I don't even know bull put spreads. Well, you're in luck, my friend, because that's exactly what we're going to talk about. So bull put spreads are also known as vertical spreads. When you start off with options, you say, okay, I'm just going to buy a call or buy a put. What I've found in my experience in teaching clients how to build aggressive wealth in the options market, call and put buys are not the simplest trade to trade because there are other things involved called the Greeks, and you have time decay, you have something called charm, which is delta decay, you have vega, you have gamma, you have all sorts of stuff. I literally wrote the book on options Greeks, so I know how complicated it can get. Vertical spreads tend to be straight directional exposure. So if you come from a directional trading background, this is where it will transfer over the best. Okay, so a bull put spread is basically you short a put right here, and that put will be at a higher strike compared to buying the put down here. So for example, you would do something like a 75 short put and then a 70 long put, and it would be called a 75-70 bull put spread. These are also known as put credit spreads. They are bullish trades, and your odds are stacked further in your favor because you can select strikes that are lower than the current price of the market. All right, so you can buy the stock, you can get long the stock, but you also get some advantages with respect to time decay and some other things that go along. That conversation could be another 90 minutes. So, Dave, you just got to take my word on it right now, okay? Jim's asking, why not debit spreads? We can get into debates with respect to what the best option strategy is. I'll be completely honest with you. When it comes down to it, delta is delta. Your directional exposure is what matters the most, right? So if you're bullish on a stock, you find a way to get long. If you're bearish on the stock, you find a way to get short. There are all sorts of advanced kinds of options trades where you can sort of bias things in your favor, and I think that credit spreads do that, especially with newer option traders. Okay, you can look at a debit spread, but the time decay risk eventually becomes a risk. And if you learn about that risk through losses, it becomes more difficult to execute on your trades because you're scared about it. All right, so credit spreads are a great way to remove some of the fear behind your trades. Okay, so I'm not saying one's better than the other. As long as you can figure out, are you bullish on a stock or bearish on a stock, you can find a way to make money with options. So the basic idea is this. We talked a little bit about this. Stocks don't go up and down. They go up, sideways, down, and then sideways and up. You have a market cycle. So you have mark up and distribution, and then mark down and accumulation. When we think about dip buying, we are scared that the stock has already gone through its distribution phase and is about to have a nasty sell-off. That's why we look at the strongest stocks in the market and look for those first few pullbacks, because odds are the stock is not going to go straight up to straight down. If it's a penny stock, that's a different game. We're talking about very liquid names. Odds are what happens is that the stock, if it does pull back, let's just say the worst case scenario tends to be sideways price action, just goes sideways for a while. And bull put spreads profit from sideways action. One other thing that you want to look at, especially with bull put spreads, is you can completely remove yourself from the equation and automate your entries. Okay? So I'm a huge fan of setting price alerts and then setting good till cancel limit orders based off of those price alerts. So here's a recent case study in Nike. All right, so Nike did, it gapped up on earnings, saw a run up to 96, and then it caught some news with the CEO left or something like that. So it sees this pull into $90 a share, rising 50-day moving average, previous price resistance, pretty good area to start looking at getting bullish. Now, if you remember the slide that we looked at earlier when we looked at the actual price action, the sucker went sideways for like 2 weeks, right? And if you just buy the stock or if you bought calls, you're not going to be in a good psychological position because you've got opportunity cost if you bought the stock because other things are running, and you've also got time decay that's working against you if you have call buys or call debit spreads. Okay. Jeremiah's got a great question, and Jake's got a great question. So we'll take a look at Jake's in just a second. But Jeremiah's got a question that says, do you set a percentage gain of your credit received, or do you hold to expiration? I am a believer in the market gods. And if you say, I'm going to hold something to expiration because there's no way the stock is going to hit it, it's going to hit a price level, the market gods will come down and they will strike you. All right, so you have to make a little sacrifice to the market gods, and don't try and hold spreads all the way to OPEX. All right, so I don't look at a percentage gain. I actually look on an absolute basis because it's easier for me to think about. So in this particular case, here's the trade setup. Sell to open, Nike, December options expiration, 82.5, 80 bull put spread. So what you're doing here is you're selling the 82.5 put, and then you're buying the 80 put. Your maximum risk on this trade is going to be the spread width minus the credit you receive. So the spread width's 2.5, and then the initial credit is 31. So that's about $220. So you're looking to make about $25 on 200. What did I say? 220. So that's about 10 to 15% return on your capital. Okay. You may look at this and you say, well, that's not a lot of reward relative to your risk, and it's not a lot on, it's just $25, right? Well, these suckers scale. You don't just have to do one spread. You can do 10 spreads. You can do 20 spreads. All of a sudden, you're collecting $250, $500, $1,500 per trade with not a lot of risk. To put this in context, here's 82.5 down here. Now, it's possible the stock runs to 82.5. It always is, right? But the odds of that happening relative to the premium you receive on the option spread is an edge, and it's an edge that I want to take time and time again. Okay? The other thing I like to do, so if I get filled, I'll automatically set a good till cancel limit order right here. Okay, because I do not want to think about it again. I don't want my lizard brain, I don't want my amygdala to come back into the equation. The other thing that I like to do is I will split my trade up into 3 tiers, which means I'll only get filled if Nike pulls back further. Okay, and I'll only get filled on tier 3 if Nike pulls back even further. There's a rising 50-day moving average, rising 200-day moving average coming into play. The reason I do that is because sometimes you're early on a dip buy. Sometimes you're not going to nail the exact bottom. And if you have a fear of missing the exact bottom and a trade moving against you, then it's not necessarily your idea that was bad. It's that your position sizing was a little off. And you just want to scale in a little bit. All right, so if the stock moves against you again, it kind of hurts a little bit. It stings. But you're kind of rooting for it a little bit to say, okay, if it pulls back, I get filled again, and all of a sudden you reduce your basis, and then you scale out again and again and again. Okay? All right, Jake's saying, I don't completely understand the tier thing you're talking about. And that's reasonable. That is the biggest question I get when I talk about this. If, let's just say, let's go into stock land for a second, and let's say you want to buy a stock at $10, right? And so you go out and you buy 1,000 shares of the stock at $10, right? And then if the stock sees a large move, all of a sudden you're screwed, right? Well, what you can do is you can say, okay, I'm going to buy 300 shares at $10. I'm going to buy 300 shares at $9. I'm going to buy 300 shares at $8. And if I get filled at $8, I'm immediately going to flip back at $9. It's called trading around a core. You can also call it averaging in. Now, I know a lot of people know the Paul Tudor Jones quote, losers average losers. That's not the case here because your averaging in is planned. You're tiering in. You're scaling in if you want. And as long as it's pre-planned, it's a very good and very lucrative method of trading credit spreads. So hopefully that answers your question, Jake. Jake also asked, what do you do about earnings? Do you just make sure you don't include the earnings announcement during the term of the option you're selling? This one really does depend, right? Because if let's say a stock is trading at $100, it pulls back to 80, and you sell some put spreads at the 70 strike, and then the stock runs back up to 100, then it doesn't matter what happens around earnings because the stock, you have such a cushion that it's okay, and normally you will have scaled out of some of the positions, so it's not a big deal. All right, if you're in a position and then you're at break even or a loss and you're headed into earnings, then you probably want to get out. I try to avoid the earnings cycle. I think that some of the best risk-reward opportunities are in stocks that are immediately following the earnings cycle where you just play that momentum or you wait for the first pullback post-momentum. You may be asking, can you flip this around? Can you look at the worst stocks in the market and then just wait for the first bounce? You can. What I've found, and we're getting into a little bit more, I'll call it option voodoo, but basically there's something called skew, and what tends to happen is that the premium available on out-of-the-money calls is less than out-of-the-money puts. So shorting with bear call spreads versus bull put spreads is a little bit harder to do, okay, because the squeezes can be incredibly vicious. That doesn't make it a bad trade. It's just something you have to consider if you're going to do that. If I were only allowed to trade one strategy ever again, okay, this would be it. I would be looking at playing bull put spreads on stocks that are pulling back. I have a lot of other trades in my arsenal. Calendars, iron condors, straight up call put buys, long straddles, covered calls, covered strangles. I've got different indicators I look at. I look at parabolic stop losses, stop loss runs, compression breakouts, things like that. But if I had to eliminate it all and say, okay, I can only trade this one or I can only show this one to people to say this is the simplest way to make money with options, This is it. Are there any questions? Bill said 40 days. So when I look at trades, there are a lot of people that sell spreads on weekly options. I don't think that's the best risk reward. It's like being leveraged with futures. Okay, and if you're a successful futures trader, then you can easily sell weekly spreads. What has happened recently, well not recently, what's happened over the past 5 years is that everyone and their mother is selling weekly options, which means that the premium is so low that the risk reward really isn't justified. It's easier to go further out in time to sell those options and then not scalp, but trade around a core like I just showed you using a tier kind of setup. So what I've got for you today, before we open it up for any more questions, there's no sale right now. I just want to get to know you a little bit better and offer some other great resources for you. So we've got the stress-tested guide to buying the different stocks, and it's free. It's going to be available Saturday morning. So if you sign up for it right now, you won't get it immediately. You're going to get the slides from this presentation. You're going to get the edited video from this presentation. And you're also going to get my custom indicator, the turning point indicator. You're going to get my option trading watch list. And you're going to get a PDF, basically Cliff Notes version of this, so you can reference it anytime that you want to take this kind of setup. Okay. When you do sign up, there's going to be a little bit more additional training, and there is something available to buy after that. I think it's just like $7. So if you want to dip your toe in the water and work with me a little bit, that's the best way to get started. So you can go to investingwithoptions.com/dip. It'll take you to a secure sign-up form. And then for all of you that are watching this on a recording, this guide will be sent to you automatically. If you're watching this right now on Thursday, it's going to get sent to you on Saturday morning. Okay? Jake is asking, do you have a specific way to determine, and we can take a look at a few stocks if you want. I know we've got some time, just a couple minutes left, so we can look at that. Jake's asking, do you have a specific way to determine the pullback point at which you sell the spread? Similarly, a time when you figure out the pullback has turned into a turnaround. Okay. Just when I talk about some of those indicators, I look at the turning point indicator, I look at the major moving averages, I look at gap fills, look at previous price support, previous price resistance, and that will allow me to anticipate where those levels are going to get hit. And then the next question is, how do you know if you're wrong? Honestly, the simplest thing is you have this short strike, and then if the stock goes underneath the short strike, that means you're wrong. Okay. So, for example, if Nike continued to sell off and then it cleared 82.50, then something has drastically changed in the supply and demand of the stock, and it's no longer a reasonable setup to take. Okay? What tends to happen when you get stocks that really start to sell off is they won't go straight down. You'll see the first counter trend bounce, and normally you can get out at tier 3, potentially tier 2 at a profit. And then if it completely falls out of bed, then you're only at a loss with tier 1. Okay. Bill's asking, besides moving averages, do you use support and resistance on a diagonal of basically of a mathematical trend line? So I think that the best in terms of ranking things, I think price pivots, so support and resistance, are very important. I think that gap fills based off of events are very important. And then you have other things, like moving averages are simply calculated to potentially have support, right? It's not true blue, we have a history of price action. It's the same thing with trend lines. I will not, unless there's a confluence of levels, I tend to not use a trend line on its own. I will look for something else. Sometimes I will look for trend lines with parabolic shorts and things like that. But let me see if I can scroll back up. Let's take an example like Apple. Right? Apple broke out from 220. It's currently trading at 260, right? There's no major price support or resistance relative to the current history of the stock. So we are forced to start looking for trend lines, and we are forced to start looking for calculated moving averages as potential levels. And the thing is, because these stock selection is one of the best forms of risk management, because these stocks are so stinking strong, that you could practically just put a random number out there, and if you're selling the right spreads, you're probably going to be okay, right? We just want to try and maximize the risk and the reward by looking at these levels. But when you look at stocks that are so stinking strong like this, anytime you get that first pullback, it tends to get bought. All right, so we're just looking for the best place in which it gets bought. Okay. Casey's bringing up, that's not the statement you were trying to make, but it's a good reference point. So Casey said, candle signals and strong diagonal trend lines work pretty good. Yes, it is very useful to look at candlesticks around these key price levels. If you see a hammer candlestick around a major moving average or a diagonal trend line, or here's the other thing that we could talk about just a little bit. Let's say you have a major trend line or you have a moving average, and then the stock sells off, and then what will happen is it will gap or knife underneath it. But what will happen is it will stop out a lot of people, and then buyers all of a sudden show up. The auction fails, and all of a sudden this morphs into a hammer candlestick. Okay, so I tend not to look at these levels as stop-loss levels because it's too obvious. I would rather see those levels where a bunch of people get stopped out. It fails to see follow-through to the downside, then we reverse higher. Okay? And my daughter is calling for me, so we're going to have to wrap it up here real soon. Any other questions before we wrap it up tonight? Jake's asking, how do you figure a safe distance below a trend line for a stop loss? What I tend to look for is just I sell the spread, and the spread, the distance between the price of the stock and then the short strike of the spread is enough of a cushion, and that tends to be my stop loss. There's also some other things that's very useful when you do that is that this is, again, option voodoo, but implied volatility and option premium rises very aggressively into that. And so it's sort of a natural calculated way to say, okay, if I'm wrong, I'm wrong. Okay? So that's going to wrap it up for me tonight. Thank you all so much for coming out. You guys are all going to get a recording from if you did register for this particular webinar. SK is asking, so you sell out of the money put spreads? Yeah, these are all out of the money. My initial credit, I'm looking for about 15 to 20% return on my capital. And then I scale in to that. All right, I am going to stop my recording now, and we'll get that edited for you as well.